Okay, good morning. Today is August 12th, and our forms today is going to be on appraisal responses and appraisal notices. So we're going to talk about what happens when you get an appraisal and it comes in under the value. What happens if it comes in at the value but work orders are called out? And whose responsibility is it to complete those orders? We'll be talking through the whole process of responding on the proper forms, the 22 AEWO and the 22 AN, and getting familiar with those forms and how those responses work. We're also going to be looking up response times for both buyer and seller to respond and discussing possible outcomes for those responses. So your appraisal has come back, and unless it comes in at value with no conditions or what they call work orders, you still have a little bit of work to do to get that transaction to close. So this part, this is the part where you need to have good communication skills and be able to cooperate and get your transaction to close. So what are those next steps? Well, if you're the buyer, those steps are going to be different from what you are going to experience as a seller. Basically, when you get the appraisal back low, if the buyer chooses, let's talk about buyer for a second. I'm going to go back to this slide. There's a couple of things that the buyer can do when the appraisal comes in low. Now, if we're talking a humongous gap in price, that buyer's probably not going to be equipped to come to the table with cash, nor will they potentially want to. And they may want to trigger the response for the seller to negotiate this, right? There are several options, and these options are bullet pointed in detail on the 22A, which is the financing addendum, as well as if there's no financing addendum, you might want to use the 22AA, which is the appraisal addendum. Keep in mind too, as long as you have not waived every single thing with your financing contingency, meaning as long as your buyer has applied for financing in a timely manner and you have not checked the little box that says that your appraisal will be waived if the financing contingency is waived, then this appraisal provision survives all things. So even if the buyer has no protection of getting approved for the amount, that's come and gone, this appraisal protection remains intact. As a buyer, there are some strategic things that you might want to think about before you put the notice through, because the way this works in good faith is if the buyer gives a notice that they want the seller to create an action in order to make this right and move towards closing, then once that action is agreed upon, the appraisal provision and the financing contingency protection completely go away. So buyers, if you're going to think about this in a strategic way, you're going to want to think, is this enough of a gap for me to want to make an action where I'm going to waive my financing? Or do I need to hang on to that protection just in case things can't come together through the end? Okay, so the first thing we do is we look at the appraisal, and you'll see probably on some random page, it's never going to be on the first page. It'll be on some third or fourth page in very, very small writing that there may be a low value, or there might be some things that that lender requires in order to fully finance. If you get that notice, or if you get that on the appraisal and choose to give notice to the seller, the form you're going to want to pull out is a 22AN. On the first 4 lines, you're going to reference the purchase and sale that you've been using, and those first 4 lines are going to be the same throughout your entire purchase and sale contract. Those are reference lines that bring us back to that transaction. Now you're going to check the box that says the buyer gives notice that the lender's appraised value of the property is less than the purchase price, and you will need to attach a copy of that appraisal when you give this notice. You have to attach a copy of that too. You can't just say that this came in low. The seller actually does have the right to see that. Now, once you receive that appraisal, you need to give this notice if you're going to within 3 days of receiving the low appraisal. There we go. Now, the timeline for the seller's response is going to be referenced again on the 22A. According to the 22A, the seller has 10 days to respond in one of these decisions below. So as a seller, if you get that notice, don't necessarily immediately respond without going through what these options are and what they mean, especially for your client. You know, we represent the person we represent. And in order to do so in a competent manner, we want to make sure that they know all of the choices they have, as well as the consequences for making these choices. So the options are, and again, these are bullet pointed in the 22A when we explain that and writing up the offer and if the seller accepts the offer. Number one could be a reconsideration of the value. Now, this reconsideration of the value is going to have to be paid for by the, by the seller, I believe. It's not here, and now I'm drawing a blank. A reconsideration of value is basically where we go back to this appraiser and we say, hey, here are the comps that I have. Will you please reconsider what you valued this home at? Now, this has been pretty successful in several instances within our office over the last 2 years. So this is definitely a viable option if the seller feels that their home was undervalued, especially with new construction. There's not necessarily a whole lot to compare to. Now, the seller can also consent to reduce the purchase price. When they reduce the purchase price, it is not necessarily going to be more than the more than the appraised value. They can consent to go down to the appraised value, or with the option on line 18, the third one, between those two on line 14 and 18, they can choose to kind of come to a happy middle ground. Now, when choosing any one of the middle ones, remember, once that is in place, once they have agreed to a new purchase price, then we are moving forward without the protection of the financing contingency, because we have already used that protection of the financing contingency to make this negotiation. So at that point, you want to make sure, buyers, that your financing is fully secured, that you'll have enough extra money to put down if needed, that you'll have enough extra, whatever it's going to take to accommodate this new value. And then the fourth option that the seller can choose is just to reject this idea altogether. The seller may say, I am stuck at 600,000 and I don't care if it appraises at 500,000, I'm stuck in my price. So buyer, you can choose to either move forward however you need to do that, or, we can walk away from this. If you're doing a reconsideration of value, it's not necessarily a quick thing. So you're going to want to get on that as soon as possible. It might take the entire 10 days. But remember, seller has 10 days to make the decision on what they want to do. So choose wisely, have the discussion, and go over all of these options and their consequences. Now, the buyer, when receiving that response from the seller, will have 3 days to decide how they want to respond to that decision. If there is any sort of negotiation for a new purchase price, then they're going to have a little bit of time to figure out if they can make that work. Go ahead and check their finances, make sure that everything is still possible to be done. Now, the buyer can choose to just terminate too. If the seller comes back and says, no, I want you to come to the table with extra money, or I'm not willing to do anything about this, that buyer does have the right to walk away from this agreement. And because the financing contingency has been used to protect them, which we only use this form if they have the protection of that financing contingency, then should the buyer choose to walk away, the buyer's earnest money will be protected and be refunded back to that buyer. There's no way that a buyer is going to be backed into a corner of not being able to close because of something that was completely out of their control, as long as they have done all they need to do to keep that contingency in place. Now, if the buyer is ready to move forward with this, the buyer is going to say, okay, I'm just going to go ahead and, first of all, you said you'd never reduce your purchase price. Buyer says, I don't care. I'm just going to come to the table with this money. At that point, the buyer is going to waive their financing contingency and just move forward with this close. Now, if there is an acceptance of a reduced purchase price, that would be line 31. So this would be the point where there's a middle ground that they want to decide on, and they've chosen to do this. The buyer should also make sure that they do have the sufficient funds to cover this. And in doing so, sellers, you're going to want to also make sure that you're in communication with this lender to make sure that the buyer doesn't have such a tight window between their approval that they can't make this work. And then the fourth option, when doing a VA, FHA, or USDA, those financing entities are not going to necessarily force a buyer to have to come up with the extra money. We've all heard of the VA amendatory clause, which is basically where the VA says, if it doesn't appraise for this, we as the VA are going to give you a contractual out to not have to go forward with this transaction. Now, buyers who are using those financing types are still able to pay the difference should they choose. It just gives them that extra type of protection. Now, when using any of the options, keep in mind and make sure you're looking at specifically, if you look at option 3, line 34, it says, buyer's acceptance of the seller's proposal to reduce the purchase price is not a notice, and it must be signed by each buyer. This is a contract term, so this is not something that one of the parties can sign. And then also look at option 4, line 39. And it says, buyer's notice that buyer will close at the reduced price must be signed by each buyer. So I know that we already do this as a habit, but there are some options in our purchase and sale agreements that will only require one of the parties to sign or initial. Those two options are not one of those. They do require both parties to sign, and they would be signing with the buyer lines right here. Now, remember, timelines are set forth in 22A under the appraisal paragraph. So this right here is a snapshot of 22A. And this is where I'm just pulling out those dates that I had originally said. In section C, it says the buyer shall have 3 days from the seller's notice of rejection of low appraisal. If the seller fails to respond by the end, then you to either waive financing or terminate. Then this earnest money will be refunded to the buyer. This is the kind of the play-by-play of how those timelines work. So again, in order to use an appraisal notice, you're going to have the appraisal contingency in there. These timelines are also noted in your 22AA. So what makes your home or property appraise? Well,
Hey, Jen, I have a question.
Yes.
So if we're doing a purchase and sale agreement and we're concerned about an appraisal, do we use the appraisal contingency? There's a line on the 22A about appraisal. Is there another form we should be putting in at the time of purchase and sale agreement or at the time of offer?
Yeah. So what if you have a cash buyer, right? And your cash buyer says, well, I still don't want to overpay. So how do I make sure I don't do that? If you are not using the financing contingency, then you can use the appraisal contingency, which is the 22AA. And it has an option, and I can pull it up after I'm done with this so you can see what it looks like. But it is for conducting an appraisal, and it's its own separate contingency for appraisals. And it also has those timelines on it. It has basically, it gives you the same rights as your financing contingency, but you're not financing because it would be a cash buyer.
Right.
Yeah. So, I mean, you can use it for, if you use a 22EF, you can use the appraisal addendum. You can use appraisal addendums with financing contingencies. If there is a waiver, the thing is, they overlap when you use the 22A. So you have the provision in section 2 on both A and B to keep that appraisal contingency by checking that little tiny box.
Right. Okay. Thank you.
Yeah. So you still have.
They seem slightly overlapping or redundant.
They're
And that makes
100%
sense now.
overlapping.
Yeah,
So
perfect.
it's only not redundant if you're using a different form of payment than financing. So,
Gotcha.
or if you're not using a financing contingency, just remember, we can have our people pay however they choose. We don't
Right.
have to have contingencies just because they're using that type of payment. But if we want a contingency, we have to put it in there. So if we have a very strong market and it's really competitive and we want to use financing, but not necessarily give the buyer the out for that contingency, then there would be no 22A. However, to protect all people, really, it protects buyer and seller to potentially allow that buyer to make an appraisal on this at their own expense and make sure that their purchase is something that is coming in at least at market value. And an example would be I did this when I had a cash sale of a property that was a hoarder property. I didn't want the buyer to accuse me because buyer was unrepresented. I didn't want that buyer to accuse me as the listing agent of overpricing it. So in our contract, we added an appraisal addendum to allow that buyer the opportunity to do an appraisal. So yes, you can kind of, they definitely overlap, and it's not necessary if you have the protection with a different form. So what it means
Perfect.
to,
Thank you.
yeah, you're welcome. What it means to come to appraise. When we write, the property shall appraise or the appraisal, this, that, section 2A, to make it appraise and to push it towards closing without having to make a further action, we want it to come in at value with no conditions. So what happens if there are conditions and maybe it comes in at value? Well, there's a new form as of 2023, thank goodness, because up until this, it was still very unclear, at least to the seller, that the buyer had an out because, of one thing or not an out because of another thing. Now, before this form was made, if a property came in at value, even if it had conditions, we would consider that appraised, and the buyer would basically be kind of hung out to dry. So there is more protection now for a buyer in the fact that this form is here and available to us. Again, with our first 4 lines, we're going to go ahead and write it up as we would the rest of our purchase and sale agreement, just to reference what transaction we're in. But if you find that the appraisal comes in and says something like deck railing needs to be fixed, this step needs to be replaced, whatever it is, you can send a copy of that appraisal with this work order sheet, with the specifications from that appraiser that say what work needs to be done in order to push this towards closing. And what this form does is notifies that seller of this work needed. Now, just because we're notifying the seller of the work that needs to be done does not necessarily make that seller responsible for doing it. What it does do, though, is it does create a conversation where now we're going to come in with our expertise and figure out how we're going to make this close, who's going to pay for it, and what we need to do in order to kind of get over this hurdle. Now, there are certain lenders who will not allow a buyer to come out of pocket with anything before closing. So you might be in a situation where a buyer has no ability to be able to do these things and is going to be depending solely on this seller to be cooperative in getting this work done. This negotiation is going to be, like I said, it's going to be our area of how we can, kind of work through this. Once you give this notice, if the seller chooses not to do anything about this and the property can't close, the buyer's earnest money is going to be protected because the buyer gave notice that these items needed to be done. And if not done, unfortunately, the buyer cannot close and keeps the protection of that appraisal contingency. So they've kind of tied this now to the appraisal. So the AWO is to be used along with the financing contingency. It can also be used with the 22AA because it is in conjunction with appraisals. And in 22A, I pulled this from Form 22A, Section D. It has a clause that allows the buyer to retain their earnest money should the work order not get done. This means the work can be negotiated, but if not completed, the buyer can keep their earnest money. So just keep that in mind. We don't want the seller to feel like they're necessarily on the hook, but it is an out because it is out of the buyer's control over what the things the bank asks for. So just a couple odd situations to think about and what you might do about it. If an appraisal comes in at $2,500 low, would you send a notice, and why or why not? Keep in mind, once you send this notice, if it is agreed upon that it's going to be negotiated with with the price lowering, then what you're doing is saying, my financing contingency protects me because of this appraisal. I'm telling you that this is low. I am going to use my protection of my contingency to get what I want, $2,500 off. And in doing so, now there's no other roadblock that keeps me between closing. So the protection of that contingency is gone. Just keep in mind with that. Once you give this notice and it's negotiated, your contingency is basically satisfied. Would you fight for a reappraisal if it came in low? As a seller, I would maybe hope that you would. Typically, when a reappraisal needs to be done, it's done out of the seller's pocket. Buyer has already paid for this appraisal. Buyer has given notice that this appraisal came in low. And if seller wants to argue that, then it's going to come out of seller's pocket. Typically, they want the same appraiser to go back. And I have seen situations where it's been a different appraiser. A lot of the situations surrounding this have been successful for sellers to get that value back up. And really, if we look at this as a big picture, we want the buyer to feel confident with their price as well. So this is kind of a win-win. What would you do if a buyer has waived their financing due to a change of loan type without the buyer broker's knowledge? The appraisal comes in low, and buyer broker has no idea that they've waived this by changing. So buyer broker submits the 22AN. Now, a couple things. This is a very multi-level question here. Buyer brokers need to know what their buyers are doing. They need to know all things about buyer's lender. They should be in constant communication with buyer's lender. On the flip side, sellers should also be in constant communication with the buyer's lender. So this thing should not come up because this type of surprise should never happen. But if it does happen and you submit it with no protection of that contingency, is the seller, first of all, the seller doesn't have to respond to this. Should they respond to this? And do they need to cooperate with this? And basically, the answer is no. The seller does not have to cooperate with this. If the seller chooses to respond to this, they may be putting themselves in a situation that would start a chain reaction of a contingency protection that was never there in the first place. So before you respond, sellers, you have 10 days to respond. Do everything you need to within those 10 days to figure out how you should respond and if you should respond, because these contingencies are only in place if everybody does what they say they're going to do. So no, seller does not have to cooperate. Should the seller cooperate? Well, that's going to be a conversation between you and your seller. The seller may say, I don't care. I just want this to close. So what? They don't have their protection. If you choose to cooperate, you may consider writing in a clause that says, buyer waives all contingencies, and this is what we're going to do about it. Or if you want to have buyer remove contingencies and sign earnest money over to seller, you could fill out the Form 50 and say, you know what, from this point forward, I'm willing to work with you to make this close, but you don't have any financing protection. So if this doesn't close, I get your money. This is going to be a conversation starter. So I'd love to hear your odd situations. If you've experienced anything like this, please feel free to share your experiences. We only learn from each other. I would love to hear what you guys have. I appreciate you listening, and thank you.